Welcome to the Fiscal Philosophy YouTube channel. I consider myself to be a value-oriented investor. I happen to own shares of Paramount Global. Now, just because I own the shares doesn't necessarily mean it's the right investment for you, but I feel that it's necessary to disclose that, just in case I might be biased here. So they are down over 25% year to date and down nearly 50% from their highs of just over $25 per share this year. Now, there's a lot of things that have happened recently with their earnings and everything else, so let's jump right in. One thing I think it's important to keep in mind when evaluating Paramount is that it's an amalgamation of companies and brands. It has not existed in its present form for very long. They have everything from CBS, the network, to Viacom and all of the Viacom channels like Nickelodeon, MTV, Comedy Central, and all of the properties therein, Showtime, of course, the titular Paramount Pictures, and they also have, of course, streaming with Paramount Plus and Pluto TV to kind of tie it all together. So there's a lot of components that make up this company. And while I wouldn't necessarily say like that they're going to go toe to toe with Disney, I do think that when it comes to Paramount, that for their market cap, they are a pretty big content powerhouse. And I think that, they are really underrated in the market. One of the first things that caught my eye about Paramount when I first started looking into it was the massive amount of shareholders' equity. There is currently almost $22 billion worth, and this translates into a book value of over $33 per share. However, a lot of this is tied up in goodwill and intangibles, which, given the nature of Paramount's business, doesn't necessarily worry me as much as with some other businesses. We live in a world where Disney paid over $4 billion for Lucasfilm, for example. So a lot of the different properties and brands that Paramount has could potentially be sold for a similar, if not greater, value than what it shows for on the balance sheet, in my opinion. One important counterpoint, of course, is that Paramount carries considerable long-term debt on their balance sheet, nearly $17 billion worth. This creates some concerns in the market where we're in an environment where interest rates are higher than they were a couple years ago. And of course, cash flows and earnings have been squeezed to an extent in Paramount. This creates a sort of murky outlook as far as their ability to drive shareholder value in the short to medium term, and those are valid concerns. With regards to their Q3 earnings, the direct consumer segment saw some of the most promising results, increasing revenue 38% compared to comparable quarter last year. This was due to increases in Paramount Plus subscriber revenue and pay-per-view events. Advertising revenue also increased due to the growth in Paramount Plus. Subscribers were up. And I think it's interesting how their operating income before depreciation and amortization has gotten closer to the break-even point. They've been losing money so far on Paramount Plus, as most streaming businesses do lose money, but they are inching closer to profitability. And I think that they could be getting ready to turn that corner pretty soon. The TV media segment, unfortunately, did not see growth the way direct to consumer did. And this, of course, means profitability is down. Why? Well, advertising revenue dropped by $270 million. And this really doesn't surprise me much because everybody is talking recession, consumer confidence is low, companies are sort of bracing for impact. And what's one of the first things that gets trimmed during tough times? Let's face it, marketing budget and ad spend. They're just not willing to bid as much on those ad slots as they are during good times. So while this is probably temporary, it's certainly being felt in the short to medium term. Their filmed media segment had an increase of revenue of 14%, which would be nice, except for the fact that the growth in expenses greatly outweighed the growth in revenue there. Now, I get it. Creating good quality content is expensive, and they may see some use out of that content across platforms, but this does definitely hurt the bottom line. Again, in the short to medium term, we're feeling it. All in all, while the market responded positively to the quarterly earnings release and the stock price went up a lot, Monday it pulled back some off the back of a Bank of America analyst downgrade, which, honestly, they're basically criticizing Paramount for not, being more willing to sell off their assets. Now, as a shareholder, I think a lot of their long-term value is in those assets, so I wouldn't want them necessarily to be in a hurry to, sell them off to the first bidder. However, this analyst feels differently and dropped the price target from $32 down to $9 just on that basis. And, my honest opinion in my heart of hearts is that this is some serious Bozo the Clown analyst stuff and doesn't really change my opinion personally on Paramount all that much. But again, that's just me. I don't really feel that great about any individual analyst being the one with the answers. And when it comes to analysts as a whole, well, there seems to be a real lack of consensus, even though the consensus rating is hold. The low price is $9, probably that Bank of America analyst on that one, and a high of $32 with an average in the $16 to $17 range. My cost basis personally is a little bit below that average number. And, for what it's worth, Berkshire also had bought Paramount, and their cost was closer to the high. It was in the $30 range, roughly, from what I can recall. Before I get into the valuation of Paramount, the DCF, and the future of the business, I'd like to encourage you all to Kamehameha that like button and subscribe to my channel, hit the notification bell so you can never miss a video. So, Paramount can be a little bit of an enigma to value, and this is actually partly why I look so much at the assets of the company, simply because if you look at their earnings that they've produced, you can see just a couple years ago, 2020, 2021, $4, $5, $6 worth of earnings seemed like it might have been normal for the amalgamated business of CBS, Viacom, and Paramount Pictures. But then you have a massive drop off in 2022 and 2023, with it looking like 2024, 5, and 6, it'll start to recover pretty rapidly. But it's hard to say past that point where it will go, as fewer and fewer analysts care to project. And, you can't possibly really know the future. But that being said, when I look at this from a discounted free cash flow perspective, if I assume their earnings and, their cash flow to match would reach 2026 levels, if you applied the standard 10% discount rate, assume their tangible book value will be roughly similar to where it is today, and apply zero growth, on that basis, it's worth $25 in 2026 with zero growth, just sitting at that same projected number. But it's really difficult to say that they'll for sure get to that point exactly, but it's also difficult to say that they won't get well past that point. So from that perspective, it's a little bit speculative. Now, I personally, have thought, in the next 2 or 3 years, I think that they will probably recover at least to maybe like the $2 mark. All right. I think that that's pretty feasible. I, of course, do apply a, 12.5% discount rate. And then like long-term growth, I really don't know, because I think there will be some up years, some down years. I do think $2 is probably quite low for what they can achieve in the long run, especially if they figure out streaming, because that should be relatively high margin, consistent revenue that doesn't necessarily have a scaling increasing cost as you go, because I think once they hit that profitability on streaming, they can really continue to feed the content in there from their other sources, from their their television media segment and their filmed media segment. So I don't think there's going to be on the streaming portion all that much cost necessarily of producing just Paramount Plus exclusive content, since they can just cross platforms from some of their other you know other brands and just put that content on Paramount Plus. So that being said, I think even if you assume like really really just like inflation level, like long-term inflation level numbers, you come out to something like low 20s, right? And my personal cutoff point for Paramount has been, I'm interested anytime it's below $20. I've been selling puts pretty consistently when it's been at or below $20. My average, of course, like I said, is just below that analyst midpoint price target they have on the 12-month forecast. I don't necessarily think that that's the actual intrinsic value of the company. I think this company is going to be hard to value overall, but I do also consider the fact that Berkshire probably paid low 30s for their shares, if not high 20s, something like that. And as far as I know, I'd have to double check. I'm not sure if I don't think they sold any as of the last 13F that I saw, but I think if Berkshire saw $30 worth roughly of assets and future cash flow potential, I think being in it below 20 is probably pretty solid. I mean, their price on Apple, for example, is I think sub 140. And so if you have a cost basis below 140 on Apple, you're doing quite well, right? And so I tend to think that Berkshire is pretty good about pricing a lot of their investments. But it is possible they made a mistake on this. It's possible I'm making a mistake on this. We're just having a conversation here. So anyways, let me know what your opinion is. Do you think I'm on base with the sub 20 point, or do you think that it's some different number? Thank you for watching the video. Be sure to raise your speech to level 100 by joining us on Discord to continue the conversation, or by leaving a comment below. Remember to subscribe to the channel, like the video, hit the bell icon, all that, and also catch me every Saturday night, 8 p.m. Eastern, on Cashflow Kings live show. Link is in the description, of course. Take it easy, everyone.